Thanks for joining me. I'm Jonathan Edwards. I'm a barrister in private practice here at Radcliffe Chambers. Today I'm going to be speaking about partnership disputes, and particularly in the context of family businesses, which is the sort of area that I tend to practice in. So this is going to last about 40 minutes. Might be able to take questions at the end. We'll see how we go. Obviously, this can only be a relatively brief overview of quite a complex area of law, but in outline, I'm going to be covering the topics of what is a partnership, the very basics, spotting one, whether one might be in play in your case, covering some of the common misconceptions which arise, particularly in the context of family business, and then delving into some of the particular problems which arise with untangling the property situation, figuring out the partnership accounts, and especially because this is so often what prompts a dispute in the family context, the effect of death of a partner. Okay, so what we'll see with family partnerships is certain recurring themes, and these are themes that will be familiar, I think, in general to any practitioner in this area. So the first of these is that the family business is often a very long-running enterprise. It's often existed for more than a generation, and people have grown up in it. The classic cases tend to involve farms, but this applies to other kinds of family businesses as well, shops, caravan parks, all sorts of things. One thing this means is that people, because they're growing up in that environment, assumptions about the long-term future can easily take hold without ever being expressly discussed. It's just assumed that things will continue more or less as they have been, but passing down from one generation to the next. Where there is discussion, and usually there will be at least some discussion, it often, because of the family context, tends to be quite informal rather, and that means that it's often quite vague and unspecific, and it's always rooted in trust rather than the clarity and seriousness that accompanies legal documentation. In combination with that, the family members often poorly understand how exactly they stand legally, and that can affect their thinking. And it's quite easy for them to have different understandings about the legal position, and they can quite easily be a long way wrong. And we'll go into a bit more depth why that can be. Another factor which isn't always present, but can be a particularly difficult one when it does arise, is you might have divisions within the family about what the business is for. Some, and this again very commonly arises with family farms, some see the business as something to be stewarded and looked after for future generations. And such people are often very keen to reinvest in the business, so that profits which are generated will not be spent beyond what is necessary, but will be used to expand or at least sustain the business. On the other hand, you get family members who that is less at the forefront of their thinking, and they see it more as a source of wealth for the family, both in the meantime as distributing profits, but also as a source of capital wealth, especially where the value of the capital assets, such as large areas of land, is out of proportion to the level of income one can expect to generate from the business. And a family member who's inclined to see things that way might have some attachment to the business sentimentally, but it is always going to be thinking about it financially, and might also begin to suspect that others see things the same way. So that one scenario that can easily arise is where you've got someone who at least says they're intending to maintain the business in its current form indefinitely. And they might genuinely intend that, people often do. But they might actually also have in mind that it can be liquidated and that the business has valuable assets. Another family member might well suspect that is the true intention, particularly when you've got business with really valuable capital assets. So, for example, farmland that runs into the millions of pounds. The non-farming family member can quite often be suspicious of a future plan which involves them getting very little or nothing, and the farming sibling remaining free in the future, either to continue farming or to give up and just cash in. So that can create quite a lot of jealousy. And I think that friction is what gives rise to many of the disputes we see in reported cases. Another factor is that, unlike most businesses, succession planning is often tied up with generations. So in most businesses, the leadership within the business will change more frequently than this. In the family context, leadership changes are very rare, epochal events. And they're also tied up with questions of inheritance from the person generally, which, as we know, comes with all sorts of baggage. And unless there's a sudden shift, of course, you quite often also have this transitional period where the older generation is handing over the baton but hasn't yet gone, or at least hasn't yet died. And it's in that period in particular that other disagreements can creep in. So again, resorting to one of the classic examples, which is a family farm, you'll quite often have multiple dwellings on the farm. And there will be a main farmhouse, and there will be other properties on the farm as well. And quite often, at around the time that a generational shift is being intended, sometimes at very different times, the older generation will move out of the main property, and the new generation will move in. But people often are still living in quite close proximity. And as we know from all kinds of neighbour disputes where people aren't related, that can give rise to all sorts of grievances and friction. And that can equally apply in the family context. And because those grievances are there, they can become tangled up with the business disputes. So these are various sources of problems. And I think between them, these factors explain why so many family partnerships, at least where there's enough at stake to make litigation possible, do end up in dispute. And of course, we don't see the harmonious ones. Looking then at basic principles, partnership is fundamentally a legal relationship, and it's essentially a contractual relationship, although it has all sorts of wider implications which most contracts don't have. So normally when we're talking about partnership, we're talking about partnership within the meaning of the Partnership Act 1890, and that's usually the legislation I'll be referring to. And that's described very simply right at the start of the Act, as it's the relation which subsists between people carrying on business in common with a view of profit. There are other kinds of partnership relationship in English law, and I've put a couple of them on the slides, but these you'll very rarely encounter in the family context. I want to clear away a couple of misconceptions. I think if you can always bear these points in mind, that will give you a solid foundation with approaching any partnership dispute. Very, very commonly, the people who are actually involved in the partnership conflate the partnership with the business as being essentially the same thing. But of course, if we're going to analyse it from a legal point of view, we need to bear in mind that these are not the same thing. The partnership is the legal relationship, so it's a bundle of rights and duties, if you like. The business, on the other hand, is something that exists in the real world, as a matter of fact. Of course, not all businesses are partnerships. You could be a sole trader, or a business can be carried on by a company or something else. But importantly, the business and the partnership are not the same thing. And one way this often crops up, as we'll look at a bit later, is that the partnership relationship can quite readily be dissolved. And when it's dissolved, it happens immediately, in an instant. The business can quite often survive the dissolution of the partnership. And so that disconnect can give rise to various issues which we'll look at later. The other really fundamental misconception which you see is people referring to the partnership as if it were a legal entity. So people talk about the partnership owning land or money being owed to the partnership. Now, often this is an acceptable shorthand, but you always need to bear in mind that a partnership is not a legal person. It's a relationship between legal persons. And so when we say the partnership or the firm is useful as a shorthand for the partners collectively, but it is not like a company. It doesn't have its own independent legal existence. Some of the implications of this is that therefore the partnership can't actually own any property. All property must be owned by one or more legal persons, which a partnership is not. And for example, in the case of land, there's a maximum of 4 legal owners. Now, that property might be a partnership asset, and we'll look at what partnership property means very soon. But it's important to bear in mind that the legal title will not be held by the partnership. It will be held by someone or some group of people. On the other hand, the partnership, unlike a company, for example, cannot be owned by someone else. The partnership requires at least 2 partners. As soon as you drop below 2, you've no longer got a partnership, because of that definition at section 1 of the Act. I think part of the reason why this misconception takes such a strong hold is that there are lots of contexts where, in practical terms, you can refer to the partnership as if it were a legal person. And you can even see that in the procedural rules in court. So where you've got the partnership on one hand and a supplier on the other hand, a contractual dispute will quite often be litigated in the name of the partnership. That is fine as a procedural convenience, and the rules do provide for it. But you've always got to bear in mind that the partnership is still not a legal person. And when you've got a dispute within the partnership, that's the key reality. I wanted to talk then about how you identify whether your case involves a partnership. First important point to bear in mind is that if a business is carried on by a company, that is not a partnership. A company is generally the beneficial owner of its assets, and so if a company can own all the business assets and run the business. Sometimes, a little bit misleadingly, people refer to companies as quasi-partnership. That comes up in unfair prejudice petitions and has various implications. But it doesn't mean that partnership law principles apply. It doesn't mean that this is a company which is subject to the Partnership Act 1890. If you're looking at Partnership 1890, you're generally not looking at a company. Another thing which is often mixed up with partnership is other situations where multiple people own a property and it generates an income which they share. The statute is very clear that doesn't necessarily mean there's a partnership between them. Not all joint ownership of assets makes a partnership. And before we get into a bit more detail on the rules, it's also important to bear in mind that the description which the parties use isn't necessarily a good guide. People quite often use partnership colloquially to refer to things that aren't partnerships in this legal sense. So if people have bought an investment property together, they might quite naturally refer to themselves as partners with respect to that property, but without having the Partnership Act 1890 in mind. Similarly, with small companies, particularly where everyone is a family member, that might be referred to as being a partnership. And in some sense, in the way we use the word normally, that's true. But that doesn't mean that partnership law applies. Finally, I just wanted to flag up that even if the parties explicitly do intend to create a partnership in this legal sense, you can't achieve that result just by saying that's what you want to achieve. This comes up particularly with tax avoidance schemes, which I won't go into because it's not really what this talks about. So sometimes spotting partnership is in practice very easy. If there is a relatively formal written partnership agreement, then in most cases it will be clear that there is a partnership. So the trickier cases are the ones where there is no written agreement. You've got a family business which has been trading, but the legal basis on which it's been trading has not been clearly documented. You might still have a good steer if people have been consistently signing partnership accounts. That's a pretty good clue that they regard themselves as being in partnership and that the business is a partnership rather than anything else. But of course, you don't always have such documents either, or at least if they exist, you might not have access to them. So I'm going to spend a little bit of time talking about how you can spot a partnership in these less clear situations where the documentation is lacking. I think a useful starting point is that when we looked at the statutory definition earlier, you've got to have a business. The business doesn't necessarily have to have been trading for very long, and in fact, there's a bit of a grey area where the business is still being set up. But you do need there to be a business. In the family context, this usually isn't a difficult issue. The family business is usually quite clear to spot in practice. One thing that can come up is that the business might have different sides to it. And this is going to be a very fact-sensitive question. That might be a business which does different things, or it might be multiple different businesses. And you could have multiple different partnerships involving the same people, or involving slightly different groups of people, perhaps with some overlap. That's always going to be a fact-sensitive question. But identifying the business you're talking about is usually the best starting point. The other thing you've got to look out for is if is a company involved. And quite often, if the business has been running through a company, then that rules out partnership. But you might still want to pay attention to it, because not infrequently there's been a partnership before everyone decided to use a company instead, and there might be some disputes hanging over from that. It's also possible just because the company exists doesn't mean that the partnership business was transferred to it. It might be that there is a company, and that company might do certain things, but there might also be a separate partnership business. And one point which won't come up in the run-of-the-mill cases, but it's worth bearing in mind, is that you might have a situation where there is an overarching business, and that business makes use of corporate entities. So I've given the case here of Campbell and Campbell. This was a family business between, there was a generational shift, but for most of the relevant period, it was two brothers. And this was a business which involved manufacturing and selling jewellery and other things across multiple jurisdictions. And so there were corporate entities in different jurisdictions, but the court was persuaded that there was nonetheless an overarching partnership, which was governed by the Partnership Act 1890. So that is a possible analysis. So just because companies are in the mix doesn't necessarily rule out partnership. If you don't have the benefit of clear documentation, you're looking for other indications. The way in which the business is run on the ground, as it were, isn't a very reliable guide. That's because you quite often see in family businesses that there is one person who is basically in charge and has the key decision-making role. But that is compatible with other people also being partners. And to give one stereotypical situation, in a family farm, you might quite often have a partnership between husband and wife. And it is typically the case that the husband will run more of the farming side and make more of the farming-related decisions. And the wife is, this is only a typical case, but it does come up quite often. The wife will quite often have the bookkeeping responsibilities. And of course, you also get situations where someone is a partner and shares in the profits without actually doing anything at all. That doesn't necessarily rule out that they're a partner. On the flip side, you can quite easily have a family business where someone is quite heavily involved and has been for a long time, but has never become a partner. And you can't become a partner simply by doing work in the business. This is probably obvious in a more professional context, where of course you can have a partnership business with employees who are partners. And of course there are more shades of grey in the family context. But it's important to bear in mind that you can look at something on the ground where someone seems to have a really important role in the business. It doesn't make them a partner. What is a much better guide is the division of profits. The Act actually tells us this is only prima facie evidence, so it's not the be-all and end-all, but it's a pretty strong indicator. If someone is sharing the profit of the business, because partnership is a relationship between people carrying on business in common with a view to profit, they are likely to come within that definition. And what you've got to distinguish between is a genuine sharing of profit and indeed losses, versus either fixed wages, which are not really an indicator of partnership at all, or other remuneration under a contract for services. And confusing thing is fixed wages. It's relatively clear that that's not a share of profit. If it is genuinely the case that it's the wages that are fixed and not just the drawings. Partners quite often agree that they will take out a steady amount each month, even though they're sharing the profits, because some profits are left in the business. But fixed wages indicates not a partner most of the time. But you can have a contract for services which is affected by the profit, and that doesn't necessarily make someone a partner. So there could be an agreement that someone will, for example, earn bonuses if the business is profitable. That doesn't make them a partner. They might still just be an employee or some other kind of worker. Okay. Moving on then, if you have got a partnership, what are the terms of this legal relationship? Well, there are two things to think about, but certainly in the context we're talking about today, one of them is much more important. First thing is how the partnership or the partners interact with the wider world. Here they can bind each other, and so it's in this context, partners and the wider world, that the partnership most looks like an entity. When you're looking inside the partnership, so how do the different partners stand against each other, then again, the partnership is not an entity, and the relationship is an essentially contractual one. And the English law gives partners a great deal of freedom to customize this relationship in the same way as that you have a great deal of freedom with contracts. And so almost everything is up for agreement between the partners, rather than the law saying it has to work this way. This has a couple of implications. It means that there's a great variety in what partners can do, and a great variety, therefore, in the factual situations the court has to grapple with. And that's one of the reasons why the case law can be quite difficult to analyse, because the cases are all dealing with slightly different situations. Another implication of it is because some disputes basically come down to number crunching and checking invoices and so on. That's the sort of thing that is well within the domain of an accountant or bookkeeper. But a lot of partnership disputes are not disputes about pounds and pence as such, whether a particular invoice was properly expended, but are disputes about what's been agreed. And that is the kind of dispute which you cannot have resolved by an accountant. That is a legal dispute, the same way that what's been agreed is a matter of contracts, legal dispute, and ultimately needs to be decided by the judge if it can't otherwise be resolved. It quite often happens, because of the way partnership is defined, you can be in partnership without realising it. And even if you appreciate you're a partner, quite often in the family context, people don't spell out what they expect from the partnership. And the Partnership Act does provide various provisions which apply by default, and we'll look at some of those. We've always got to bear in mind that those are not rules which are being imposed upon the parties. They fill in gaps, and if they've agreed something different, then their agreement will apply instead. And what Section 19 makes clear is that can be either an express agreement, written or oral, or you can find it from a course of dealing. So although looking at a partnership agreement, if there is one, is extremely important, you've always got to keep at the back of your mind that the words on the page are not necessarily determinative, because the partners might in practice have agreed something different. I said we'd come on to the question of partnership property. This is quite a complicated area in its own right, so this necessarily has to be a brief overview. I mentioned that the partnership can't own land, and that all land has to be owned by one or more individuals. This goes for other property too. All property which is partnership property is held on trust by the legal owner or owners, and therefore they don't own it beneficially, even if they did in the past. Instead, it's held on trust on the terms of the partnership. Not infrequently, partners think that they have a percentage. So if they've been sharing profit, let's say in equal thirds, they might think that they own a third of each field, or any other asset of the business. That is not the case. It doesn't work that way legally. While the partnership is continuing, the partner's entitlements are governed by agreement. And of course, usually that amounts to a share of profit. On the winding up of the partnership, again, if the partners have agreed something, that will apply. And then there's a default provision, which we'll look at. But neither of these things amount to only a specific percentage of all the assets. Very often in partnership disputes, an absolutely key dispute with the highest financial stakes is whether something's partnership property or not. Because it's easily possible for an asset, and again, the most valuable assets tend to be land, so that's often what we're talking about, and often what the cases are dealing with, where the assets are used in the business and are often absolutely essential to the business, but aren't necessarily partnership property, aren't held on trust in this way. It can be that someone, not necessarily a partner, but usually a partner, owns the land in their own right and merely lets the partnership business use it. That's often an absolutely critical question, and there is no very simple formula that you can apply to identify. It's a very fact-sensitive question, and it's usually going to be a key focus in your partnership dispute. But to approach that issue, you've got to have a clear understanding of what partnership property is and how it works, which is, I find, quite different to what the partners often seem to expect and what they believed the position to be. The partnership share is a helpful concept. This is a term which you can use as shorthand for all the bundle of rights together with the duties that each partner has. Again, this can't really be rendered as a percentage share. What the share is actually worth will depend on what the partners have agreed. So a partnership share can actually be worth, in terms of cashing it in, nothing. It's not uncommon to come across partnerships where the partners have expressly agreed that if you want to leave the partnership, you can, that can't be stopped, but you can't take any of the assets with you. That can be agreed. Or the partnership agreement might say that you'll be bought out in some specific way. And if the partnership agreement says that, then it's no good saying that you thought you owned a greater stake. But quite often, this is not spelled out, and so the default provisions can be very important. The default provision, if the partners haven't previously agreed something different, is that any partner can dissolve the partnership simply by giving notice. And if they do so, any partner is entitled to have the business wound up. And that usually means the business being liquidated and the assets sold, although the court can order otherwise. The court can order, for example, that the other partners are to be given a chance to buy the business. Whether the business assets are liquidated or whether someone buys them outright, Section 44 is the provision which applies by default about what happens with the proceeds. And again, like almost everything else, this is subject to contrary agreement, but the default position is this. The assets of the partnership are applied in the following order of priority. First of all, creditors of the business get paid. And then so you look at the net assets. Well, the partners get paid first is any money that they've loaned to the firm. So they rank behind other creditors, but next in priority. I tend to come across as relatively rarely in practice. What you will come across is capital. So this usually, but doesn't need to, involve the partner contributing some assets out of their own resources and making them into partnership property, which means that they cease to be the beneficial owner and instead those assets are held on trust on the terms of the partnership, as we saw earlier. This doesn't have to, but it will usually mean that they're regarded as contributing capital of the value of those assets. This gets repaid first. It is only once all the partners have had their capital returned that whatever remains is treated in the same way as profit and is divided accordingly. So on a dissolution, you're often looking, assuming that the partnership is solvent, so creditors can't be paid. We're often looking at what is each partner due by way of loan to the business or capital contribution, because that is what can take you away from the profit shares. The partners quite often assume that the profit shares will usually be a percentage agreed and will apply generally, but this isn't actually how it works. And I'll go on to a worked example in a bit. Before I do go on to that worked example, I wanted to talk a bit about partnership accounts. The problem with partnership accounts is that they can be a good guide. They can be the most important documents in the case, but they're not always reliable. And there are various reasons for that. Essentially, it comes down to, it depends on the quality of the input. If the accountant is given confusing or incorrect information, the account's going to be wrong. A slightly more subtle factor is that usually when both the partners and the accountants are dealing with the accounts, often in practice, this is being done to comply with tax obligations. And so it's the profit, which is taxable, that everyone is focused on. And how the partners stand as against each other is not really thought about. And that's how uncertainty tends to creep in. And one factor I notice, because these are often very long-running businesses, you often won't have the same individual doing the accounts all the time. And accounts can be carried forward from when the business was run by a previous generation. So it might well be that you've got entries carried forward in accounts that no one now understands why they say that. And so either something can be a complete mystery in the accounts, or people can think they know what it says, but actually, if you do the archaeology and you trace it back through the accounts, it came about in a way that is not what they assume. If you're delving into the detail of partnership dispute and trying to work out what's this boil down to in money terms, ideally, there will be a point in time where you've got a solid starting point. Everyone agrees that at this time, the position was X. If you don't have that, if the uncertainty goes back for as far as you can see, there's not really any alternative to getting as historic material as you can and trying to work out, just by going through chronologically, what has happened. That's really the only way of unraveling the truth and uncovering any mistakes that have been made over time. And even then, you might not get to the bottom of it. Because partnership accounts are not definitively reliable, they're evidence of the true position, and often they're vital evidence, but they're not necessarily determinative. So if your client as a partner is saying, well, it says that on the account, so that must be right, note of caution is required. Hammond Bell is one of the cases where this point is made, and in particular that was a case where the court was satisfied that the inclusion of some property on the accounts, which suggested it had become partnership property, was a mistake. And actually that property was always intended to remain in the ownership of one or two of the people who happened to be partners, but not partnership property. They were intended to own it in their own right. And so when it came off the balance sheet, that was merely correcting an earlier error. And very often, because these are the most important entries on the balance sheet financially, that's what you're particularly paying attention to. So caution is required with partnership accounts. However, the court doesn't have any great enthusiasm for unpicking accounts where there's nothing obviously wrong with them. So partnership accounts can become binding, even if they contain some errors or might contain errors, if they've been agreed between the partners. In the same way that if you've got a dispute and you compromise it, then you can't unpick the compromise later just because the true position was something different. It becomes progressively more difficult to unpick accounts, basically the longer that they've continued to say something. Whether it's possible to do in your case will depend on the circumstances. In particular, the seriousness or the obviousness of the error, whether it's being caused by misrepresentations, especially fraudulent misrepresentations, or people signing accounts that they didn't agree with because they were put under pressure to do so. Those are the sort of factors that are in play. One accountancy question that comes up is capital accounts and current accounts. So I won't go into detail on this, but this is the side of the balance sheet which represents how the partners stand as against each other. It is often a real muddle, and you often see that even within the same business, the accounts change in approach from year to year, very, very confusingly. So great caution is required with these figures. These figures can quite easily be misleading, even if otherwise the accounts are pretty accurate. I want to give you an example of that. Or an example of how partners who don't understand these quite complicated legal principles can easily be led astray. So let's assume that two people go into partnership and just agree equal profit shares for simplicity. And we'll imagine this case where one of the partners owns some land in their own right, but they decide to make it partnership property. Unless something else has been agreed, that ought to be treated as them contributing an asset of that value, we'll say £100,000. We'll imagine that the business trades for some time and it does so profitably, so there are no losses. The partners take out drawings equally for simplicity, and we'll say that £100,000 profit is retained within the partnership business. I'll gloss over whether that profit became capitalised or not, but it's worth bearing in mind that that's another little nuance that can apply. And so you would expect in this scenario the accounts to show at the bottom line 150,000 partner one, the capital contribution of 100 and the share of profit of 50, and 50 for partner two because they didn't contribute any capital, but they've got the same share of profit. And what this can be misleading for is you might assume, therefore, that this ratio of 3 to 1 reflects the ratio that will be the outcome if the partnership is cashed in. But we'll see that's often not the case, because assets can change in value, and particularly with land, you will tend to expect it to go up over time. So in this example, we'll assume that it's gone up to 250,000. And that's obviously quite a lot, but this partnership might have been going on for a long time. And quite often with family farms, the land is on the accounts with a book value from decades ago, when it's tiny compared to its actual current value. If nothing else has been agreed, that increase in the value of the land will be treated as profit, and it's divisible in the same way as other profits, so profit from active trading. And so you've got total assets now of 350. You've got the land worth 250 and the retained profit of 100. Applying things in the order that we looked at in the section 44, what partner one will actually get is 225. Partner two will get 125. So the ratios end up being quite a bit closer together than 3 to 1. That might come as an unpleasant surprise to partner one. On the other hand, it might come as an unpleasant surprise to partner two if they've been looking at the accounts and look at the figure of 150, which is in the accounts, and think that to buy out partner one, that's what I have to pay. If they learn that actually it's 225, they might be rather disappointed by that. And this isn't always assuaged by telling them that this is because the assets are worth more. And so that's how, firstly, the outcome can be unexpected to the individuals, because it doesn't look like that will be the outcome just from looking at the accounts. And it can disappoint either of the partners or even both of them. This is a very simple example, but hopefully that makes the concept clear. In any real case, you're likely to find that this issue is in combination with all sorts of other uncertainty. All right, well, I am short of time, so I'll deal with this briefly. Partnership and death. So the default position is that partnership will be dissolved by the death of any of the partners. The partners can agree in advance that the partnership will continue. But this is the default position. Now, this is quite often overlooked. And so even though the partnership has been dissolved, everyone just carries on as before, but without the deceased partner. This legally necessarily means there's a new partnership. And quite often this isn't a problem. As long as everyone with a stake is agreed, so both the continuing partners and also the personal representatives and maybe beneficiaries of the deceased partner, this is fine. Because remember, everything is governed by agreement, essentially. So if everyone agrees that it should happen, that is fine. But of course, in disputes, we're interested in what happens when people don't agree, when this prompts a falling out. So one thing to watch out for is section 43 of the Partnership Act. This section has been described as obscure in one of the leading textbooks. What it says is that where someone leaves the partnership, and for simplicity, I'll use the example of a partner dying, that their share, which is the bundle of rights, which we looked at earlier, is treated as a debt accruing at the date of death. Quite how this section works is debatable. So what I say next is my take. I'm very sceptical that this provision has any application where you've got a two-person partnership and one of them dies. I think then you've just got no partnership at the end, and I don't think this section comes into play. Because this section assumes that there are plural surviving or continuing partners. Where it does apply, and always bear in mind that the partners, this is subject to agreement, so they can agree something different. Where it does apply, what it seems to require is that the partnership share, so the bundle of rights, is valued at the date of dissolution, or the date of death in our example. This isn't beyond argument, by the way. I have seen it suggested that this isn't the case. But it seems to me that what's required is a hypothetical calculation as at that date. Another implication of this is because it's a debt, it can be barred by limitation in the same way as other debts can be. Although if you've got a partnership agreement which is a deed, limitation period is probably going to be 12 years. If this happens, then the continuing partners have got a bit of a windfall, because the partnership share, which might be quite a weighty entitlement, particularly if that's a partner who contributed a lot of capital, if that becomes a debt and then becomes time barred, the continuing partners have the assets, and now they no longer need to pay this debt because it's time barred. So that can be a huge windfall. And a huge disappointment if you're not a continuing partner, but you're a beneficiary of the estate. Another sting in the tail is section 42. This is something to watch out for if you're on the side of the continuing partners, especially. People say possession is 9/10 of the law. There's actually a huge risk to just continuing the business if one of the partners died and you're in dispute with the personal representatives. And that's because of this. Take the partnership share of the deceased former partner. This can be worth a lot of money, particularly if there's valuable partnership property. And so that on a dissolution, they'd be entitled to a big share. They're entitled at their choice to a share of profits or interest at the rate of 5% per annum on the share. That's been described sometimes as a low rate. In the present environment, that's quite a high rate. And that could be 5% on a very large sum. If you've got a farming partnership with assets worth millions, the share of the deceased partner might itself run into 7 figures. And 5% a year on that is going to be a lot of money, particularly if the dispute runs on for a long time. And you can incur this liability without appreciating it quite easily. So this is really a danger if you are continuing the partnership. And certainly something to watch out for. And if you're on the side of the deceased partner or their representatives, you don't want to forget about this. This can be a very valuable right. There are some ways out of this liability. So one of them is if the partnership agreement gives the surviving partners an option to buy out. As long as they fulfill that option, then section 42(1) doesn't apply. More generally, as with so many other things here, it's subject to agreement to the contrary. And I've given you on the slide case of Morton and Morton in the Court of Appeal. This involves a very niche question about the outcome of a proprietary estoppel claim. But here, to give you an illustration, the interest amount was in excess of £700,000. So it was serious money, and it made a real difference to the parties. The Court of Appeal was persuaded that in that particular situation, this liability was actually excluded. But if the Court of Appeal had decided differently, that would have been a very hefty liability and a big problem for the people who had continued the business. So that is absolutely something to watch out for. I wanted to finish up very quickly by saying that proprietary estoppel is something that comes up in family disputes of all kinds very frequently. There are some particular difficulties in the partnership context. Firstly, your claimant might be a partner, and if they're a partner, they might well have signed up to some agreement. And unfortunately, in the family context, people quite often sign up to agreements either without properly reading them, without having them explained, or just assuming that although it says that will never happen because we operate on trust. This can really hem in what you can argue. And the big cautionary tale is Horsford and Horsford, where the claim failed altogether because the claimant just ran up against the fact that they'd signed up to a partnership agreement which just ruled out their claim, basically. In Morton and Morton, which is the case I was involved in, we were able to escape that conclusion. The claimants were partners. They had signed up to a partnership agreement, but it was possible to formulate the proprietary estoppel claim in such a way that it wasn't incompatible with the contents of the agreement. But that also requires some careful thought. You might also have a claimant who's not a partner. In fact, their grievance might be that they were promised they would become a partner, but then the partners failed to make good on that promise. Here, the thing to be careful about is that the property is not owned by any one of the partners. It's held on trust for them all on the terms of the partnership. This is not a problem if all the partners gave you assurances, at least if they gave you all the same assurance, or if they've conducted themselves in such a way that they're bound. For example, if they knew about the assurances being made and they, by doing nothing, tacitly endorse them. But you might have a situation where you've got an assurance from one partner, but you've had no contact at all with another partner. And then you're going to have great difficulty targeting the whole partnership because the partner you've had nothing to do with will say, well, why have you got a proprietary estoppel against me? I didn't make you any assurances. And here, in that scenario, your target could probably only be the entitlement of the partner or partners who did make the assurance. And because they don't own a specific percentage of the partnership, it can be really tricky to come up with a remedy for this. You can't say hand over 20% of the partnership because they don't have a specific percentage. So I don't have a simple answer to that. It's just a tricky point. It's something to watch out for. Right, well, I'm sorry for overrunning. I think I won't take any questions, therefore. But my email address is on the slide at the end, and I'd be very happy if you do have any questions to receive them by email, and I'll give you my thoughts. Well, thank you very much for listening, particularly if you have stuck around to the end, but I hope it's been useful.